Welcome back to the Funding Blueprint, where we dive into the journeys and insights of the most innovative minds in the startup world. Today we have a special guest, Jim Miller, a seasoned CFO and entrepreneur with over 20 years of experience in accounting, strategy, and profitability. Jim has guided both startups and billion-dollar brands, showcasing his exceptional leadership and expertise. Beyond his professional achievements, Jim is an award-winning personal finance author who shares his valuable content on LinkedIn and Instagram. He's also a dedicated husband and proud dad, bringing a personal touch to his professional wisdom. Originally hailing from the suburban Chicago, Jim has spent the last 2 decades enjoying the sunny skies of Southern California. In this episode, we'll explore Jim's journey, his insights on financial strategy for startups, and his advice for building entrepreneurs. Get ready for an inspiring and informative conversation with Jim Miller. Let's welcome Jim to the show.
Hey, thanks very much, Abraham. I'm excited to be here.
Of course, happy to have this conversation with you. So I want to kind of dive right in. The startup world has a lot of financial jargon and concepts at founders, from burn rate to runway. Founders get a crash course in the basics. But what about these hidden gems, right? The lesser known strategies that can make a real difference in a startup's financial health. Jim, you've been guiding startups and billion-dollar brands for over 2 decades. Beyond the core accounting principles, what are some of those hidden gems of startup finance that early stage founders might be overlooking?
Yeah, great question. Let's get into it. So, first of all, you don't know what you don't know. And I hear that all the time from founders. Surround yourself with people who have done it. If it's okay, let's get into the KPIs and the tax goals a little bit later in our conversation. Both are critical. I'm a big proponent of outsourcing, and there are things that just don't make sense to bring in-house, until your business is making at least, call it $15 million a year. And, some of those examples are human resources, legal, marketing, and accounting functions such as bookkeeping and CFO work. And, even then there are stages. So you don't need outsourced marketing if you're earning less than $1 million a year in gross revenue. You should be doing it yourself. You don't need an outsourced CFO if you're earning less than $2 million a year, typically. But outsourced legal, for example, you need that from day one. And, ultimately, and people don't like to admit this, but business, this whole game is all about money. And you need to create sales both inside and outside of your business in order to get more money. And you create more money so you can help or service more people, do good things. If you go to a networking meeting, for example, you're doing that to get more sales and ultimately more money. This podcast, I'm doing it to share, what I know with more founders with the hope that some of you become clients so that we, you and I can get more money. And it is okay to like money, especially when you use it for good. And especially, of course, when you give back as much as you can. So, my business is to help people create and then keep more of their money. And I do that through Astero Group, my CFO firm. I help business owners earn and keep more of their money. I do it through the personal finance world to help young adults learn how to earn and keep more of their money. Now, back to owning a business. So, you don't create wealth by expensing little receipts for deductions and saving on taxes. And that's what we all do at first, but that's small thinking, it's rookie. And we'll talk about all this, but you grow wealth by growing your business and then strategically moving profits out of the company and investing them elsewhere. And a key word there is moving, and we'll talk about that, but you need to move your money to grow it. And that could be, you've heard of a SEP IRA or a Roth IRA or real estate assets that you create that will grow independent of the business. And there are financial institutions where you can even invest outside of Wall Street. So Equity Trust, I have nothing to do with them, but they're one, 100-year-old company example of those companies. So you can create a retirement account there and you can invest in alternative assets. So it could be real estate, or for some people, crypto, or even metals. A key is our tax code is designed to make you wealthy. You just need to learn how to follow the tax code so you can move your money to the right places.
100%. No, that's well said. Founders naturally want to keep as much of their hard-earned money as possible, while also ensuring that their startup has a healthy financial foundation. This creates quite an interesting dynamic, minimizing taxes while maintaining a strong net income. So, Jim, with your expertise, can you help us understand and comprehend really how founders can optimize their financial strategy in this area? Are there specific strategies or tactics that founders can employ to lessen their tax burden in a way that's still attractive to potential lenders and investors?
Yeah, so destroying net income for the sake of paying as little tax as possible is a strategy. And depending on the third party, kind of recipient, they may allow you to provide them with an adjusted P&L that backs out some of those items that were booked for maximum tax impact. So for example, if you're a company that buys some assets and it's kind of on the fence whether they could be capitalized to your balance sheet or expensed in your P&L, a lot of companies will very fairly, of course, and following the tax code, expense them through their P&L. But what that does is it, decreases their overall performance from a P&L standpoint, whereas in actuality, they're, saving money on the tax side. So you need to consider both outcomes and the story you want to tell and the story that you want your numbers to tell. The problem that I see most often, especially in December for calendar year businesses, but is that the business owners go out and they spend in December to reduce their taxes, not realizing that only a portion of the spend is deductible, right? So then cash gets buried, and then they go into a new year in a rough position. And you can't start at zero each year and expect to gain wealth, but this is what so many do. So they'll have a great year, they'll have $3 million in revenue. At the end of the year, they'll crash it with purchases and bonuses and stuff like that. And then they'll start the new year basically at zero, and they'll just, maybe that's $3.5 million the next year in revenue and $4 million, but they're just kind of doing this to zero every year. And if that sounds familiar to any of you listening, that's okay. You're not alone. Millions of businesses treat their businesses that way. But what I would recommend is moving some of that money outside of the company, whether that's you and or a partner, equally moving those shares out or based on a percentage of ownership so that you can use that money to grow wealth outside of your business in other areas. So do spend money on things you need and focus on getting those investments to produce ROI in the business, but also get the money out of the business for personal wealth creation. To be more specific, that's usually done via retirement contributions or draws, and it depends on the structure of the company. But that's what I would recommend as a critical action item for everyone listening. Get some money out of the business so you can grow it out there and really grow your own wealth.
Agreed. Couldn't have said it better myself. Fast forwarding now to talking about planning for the future, right? Financial forecasting can feel like staring into a crystal ball, especially for early stage founders with limited tax data and a lot of unknowns. But here's the thing. Forecasting isn't just about predicting the exact future. It's about illuminating the path ahead. So with your experience, what's the importance of financial forecasting for startups? Can you help us unpack this concept? Why is forecasting such a vital tool, even for young ventures? More importantly, how can founders make forecasting a manageable process, avoiding complexities, but still gaining valuable insights to guide their decisions?
Yeah, well, I'm glad you used the term forecasting first of all, because I dislike the term budget. A budget to me is a license to spend, and it just brings back memories of these companies spending, an entire month, and everyone hates it, and they put these numbers together, and it's sort of a ticket to spend money instead of really forecasting the performance of the business. So that's an important word adjustment for me. In my firm, Estero Group, we don't use the word budgeting at all, unless a client is really, really a big fan. And even then we try to change their mind and steer them towards more of a forecasting future. So forecasting is critical, right? But make it easy. Don't spend a month doing it, especially if you're a business owner who's not an accountant, right? So you want to look ahead 5 years, 10 years, whatever, but your focus should be on 60 to 120 days out above all else. It doesn't matter. Do it on a notepad. Determine which expenses are a percentage of revenue, which have other drivers. So learn your drivers. And by driver, to be clear, I mean those things that drive expenses to be what they are. So you might have cost of goods sold categories that the driver is per unit sales, so it's revenue. You might have other categories where it's related to the number of employees, so it's different for different things. And you can use spreadsheets, Excel or Google Sheets. At my firm, we use software for most of our clients' reporting and forecasting needs. There are some cool options out there these days. Fathom is a major one that we use and love. There are other great tools out there. I won't list them all. But it helps to have an expert handling your forecasting as soon as you can afford it. And a fractional CFO, once your revenue is over $2 million a year, becomes critical. They can do all this for you. But until you're at that stage, forecast as best you can. Keep it simple and just use it to gamify what you're doing and see how you're performing towards your goals. And make it realistic, but make it difficult. Think big. And those are my thoughts around forecasting.
Some great points. I want to talk about personal financial success for a second there. The startup dream is often accompanied by the aspiration for personal financial success. But for founders, especially in the early stage, there can be a tension between prioritizing company growth and building their own wealth. It can feel like a zero-sum game. So you've undoubtedly encountered founders grappling with this balance. Can you offer some insights on strategies that founders can utilize to build their personal financial security while simultaneously, at the same time, really focusing on propelling their startup forward?
Yeah, it's so interesting, and I've got something interesting to share on this one actually. And I was just rereading this book. So, first of all, you're right. In the early stages, you need to first become profitable. So nothing happens without a sale, and all of this conversation we're about to have will start at the point of profitability. First, let's agree, if we can, that a business needs to earn itself a profit, and that not all profits need to be reinvested into the business. So, do we agree there?
100%.
Okay, awesome. So here's a strategy that I know can really help your listeners. There's a book called Profit First. The author is Mike Michalowicz. Sorry, Mike, if I'm mispronouncing your last name. I think it's Michalowicz. And it's sort of the pay yourself first strategy that we recommended in the personal finance world, including in my book, but for business. And Profit First is a book that argues for a counterintuitive approach to small business accounting. So traditionally, as businesses see profit as what's left after expenses are paid. So sales minus your expenses equals your profit. And what Profit First does is it flips this formula. So advocating that a percentage of income is allocated towards profit first, with the remaining amount designated for specific business expenses. And the book outlines a system using, they have multiple bank accounts to automate this process and, really change a business owner's mindset from reactive spending to proactive financial management. But why this matters for today is that it helps ensure that profitability is created first, and that they're, regardless of expenses, it's there for the owner to move and grow. So, let's say in simple terms, your business makes $1 million a month, and, you say conservatively you want 10% profit. You're going to move 100 grand into a separate account at the beginning of each month. Some people can do this quarterly, whatever it means for your business. There might be little differences there, but you move the money out. So the money literally isn't there for your business to consume in terms of expenses and needs and reinvesting and purchases and that sort of thing. And you can share this with your team. And then, the business has to make hard decisions sometimes, or learn how to be more resourceful given the money that's there. But I've found this to be super helpful, for a lot of our business owners. And we don't have to go into the deeper tax side of this, as it varies from situation to situation. There's always, as far as the wealth building, there's everything from captive insurance policies and other post-tax investments. And there are ways to move money that can create deductions that offset a major portion of the business owner's income. Real estate, of course, being a popular choice. But whatever you decide, here's a quote to remember. And this comes from a very successful entrepreneur, a best-selling author times like 15, and a friend of mine named Greg Reed, who said, "Successful people seek counsel where failures listen to opinions." And I think that's so important. So, get counsel, get advice from people who have done these things, and don't listen to opinions. I won't go into, how many questionable opinions might be on there. Surround yourself and find people who have done the things you want to do. And lastly, I'm rambling on this one, but it's an important one. But from a growth strategy standpoint, do the forecasting. We just talked about that, but forecast so you can set the expectations and then manage the wins and losses of the business, and consider doing the profit first method as part of that as well.
For sure. For sure. That's great advice. We talked about forecasting recently, but I want to kind of jump now and start talking about KPIs, key performance indicators. The world of startups, throws around a lot of acronyms, and KPIs, key performance indicators, are no exception to that. But these aren't just fancy letters. They're actually the compass guiding founders towards success. However, with the sea of metrics to consider, founders can get a little overwhelmed. So, Jim, you've seen countless startups navigate the early stages. What are some of the most critical KPIs founders should absolutely be tracking to ensure that they're on the right path and their businesses is gaining traction?
Yeah, I love this question because we get it with all of our clients, and I hear this all the time. And I have an opinion on it. So, leading indicators, let's break down kind of KPIs, or key performance indicators, like you mentioned. So, there are leading and lagging indicators, and leading indicators are forward-looking metrics that predict future performance. So, customer satisfaction for sales growth, Lagging indicators, on the other hand, reflect past results, so sales figures, revenue itself. And every business is different, but I would say the core items to focus on are, of course, your AR, your AP. You'd be surprised how many clients don't look at those things on a weekly basis. Customer deposits, cash and cash burn. And then there are really two main categories. So there's financial health and customer engagement. And financial health, so I break it down to a few key areas. And some of this is focused a little more towards tech companies, some of what I'm about to talk about, but not just for tech companies. So we have customer acquisition costs, often referred to as CAC. How much does it cost to acquire a new customer? There's your burn rate. So that's the rate at which you're spending cash. In the tech world a lot, you'll hear about MRR. So that's your monthly recurring revenue, or you'll hear ARR, which is the annual version of that. And it's predictable monthly revenue from subscriptions or contracts. We also have LTV, or lifetime value of a customer. So that's the total revenue a customer generates over their relationship with the business. Every business should know their LTV. And a good benchmark for LTV to CAC ratio is 3 to 1 or better. Generally, 4 to 1 or higher indicates a really strong business model. And then, on the customer engagement side, so you've got customer churn rate. That's the percentage of customers who stop using your product or service. It happens. If it doesn't, you're lying. Your monthly active users, number of unique users engaging with your product each month. You've got your net promoter score, NPS is what you'll usually hear that called. And that measures customer loyalty and likelihood to recommend your product. And just in quick, to calculate NPS, you want to ask your customers how likely they are to recommend your business. I usually recommend just a 1-sentence survey on that one, and score their answers on a scale from 0 to 10. Subtract the percentage of detractors from the percentage of promoters. So for example, if 70% of respondents are promoters and 10% are detractors, your NPS score would be 60, so 70 minus 10.
Great points. I think for individuals that aren't really well versed, specifically founders that don't have an accounting background, what you just said is actually quite powerful to them, and it's important. I mean, whether you have a SaaS business, whether you're in a tech space, whether you're actually developing a physical product, all these terms are crucial and vital to your accounting needs. So 100%.
And look at them weekly. I want to make sure I add that. Look at them weekly. Yeah.
100%. I want to move on. I want to talk about the fundraising journey for startups, and that can really feel like an intense financial audit, if you will. Investors start to sift through data, their reports and metrics, as all really as a part of their due diligence process to assess a company's potential. But for founders, navigating this data, the deluge can really be tricky. So with your background guiding startups through funding rounds, what are the absolute must-have financial metrics and reports that founders should present to their potential investors? From my perspective, it's really just a matter of showing profitability, or is there really anything that requires anything other than just growth indicators that investors really prioritize?
Yeah, so another excellent question, and this is a big one, and you're going to hear different answers out there, and I'll tell you what I've found in my experience, and I've seen many companies raise capital. I've seen ones that haven't, and what it really comes down to is the story you want to tell, and that's a little different for each company, but the numbers tell a story, and that's why a CFO can really be helpful in some of this. And most good founders are also really good at telling the story, but you need to make sure your numbers tell that story too. So if you're talking about a certain growth level, you need to make sure your historical numbers tell the story of that growth level, or something about your product. So let's get a little more specific. When raising capital, investors are ultimately going to look at a combination of financial metrics and reports to assess, the potential of your startup. And the most critical ones, so there's your financial statements, of course, core reports, balance sheet, your income statement, also called the P&L, and cash flow statements. They provide a snapshot of the company's or the startup's financial health and stability. Another would be the runway. So this metric shows how long a startup can operate with its current level of cash burn. It indicates how much time they have to achieve profitability or to secure further funding. Unit economics, that's a big one. This analysis focuses on the economics behind acquiring and retaining a single customer on a per unit sold basis. So investors want to see a clear path to profitability, and unit economics help demonstrate that. And I guess two more. So growth metrics, which I think you mentioned, Abraham. So investors are particularly interested in the startup's ability to grow its user base and revenue, obviously, and metrics like user growth rate, revenue growth rate, and customer churn rate, like we talked about in the KPIs. Those are going to be closely examined by any sophisticated third party. And lastly, and I sort of touched on this, but it's your burn rate efficiency. So not just your burn rate, but your burn rate efficiency. And while a high burn rate might be acceptable, for a fast growing startup, demonstrating efficiency in spending that burn rate is crucial. So investors will look at metrics like your CAC trends, LTV over CAC ratio to see if the company's getting better at acquiring customers for less money. And, in addition to these core metrics, a strong financial model really that forecasts future performance and funding needs will be the essential ingredient for attracting investors. This is the model that needs to tell the right story. This is another area, like I said, where it can be key to have an experienced CFO or fractional CFO assisting here. It can be the difference between getting the funds you need or running out of cash. But that model is probably the most important piece of that conversation with third parties.
That's great advice. I mean, we've covered a lot in just a short amount of time. But now I want to kind of shift our focus and focus more on your company, Asterio Group. So lastly, to really close off our conversation, what are the best ways for our audience to stay updated and learn more about the innovative work that's being done in Asterio Group?
Yeah, I appreciate it. And thanks for asking. So they can visit asterogroup.com. So it's ASTERO group.com. And probably best for your audience especially is sign up for our monthly newsletter. No one wants more emails. This is once a month. It's short, but packed with the latest news from the last 30 days that could help your business. New government programs or offerings, all kinds of actionable tips to help both the business and the business owner grow in the right way. Each email newsletter has all my personal links in there too. So feel free to get in touch. I'd love to talk to you and help you if I can, or share information with each other. I'll just go on for a couple more seconds on this, but the newsletter is called the Asteropreneur, and we coined that term at my firm, and it describes the high potential clients we like to work with and that we work best with. So these are growth focused people who start and operate a profitable business while also mastering the numbers and KPIs of the business. And by mastering, I just mean they have an interest, but this excludes a lot of people who fall under a more typical definition of entrepreneur. The goal of the monthly newsletter is to turn entrepreneurs into Asteropreneurs. And our experience has been, real world, that Asteropreneurs have a better chance at receiving capital, landing bigger deals, and creating personal wealth in that process. Asteropreneurs think bigger. They focus on the real things and ignore the fluff. They understand what they truly need to focus on in their business. So, for example, and using kind of me as an example, but if you're a B2B service-based business, right, your outbound sales or your sales should not aim at other business owners. You'd think so, because that's who you're selling to ultimately, but it's not, and you need to think bigger. It seems counterintuitive, but you should aim for the partners who have similar customers as you do. So maybe it's fractional HR companies or fractional marketing CMO companies. Your business also, in this case, is not sales and marketing. That's not where you should be spending all your dollars. You have to do some sales and marketing, but your real focus needs to be recruiting and retaining the best talent. That's really what you do. For any service-based business. And, as you grow, and if you're really thinking big, that can be done via profit sharing or giving away equity. All the biggest consulting firms and service firms, they have people that work to be a partner in that firm. So let your people share in the wins and losses of the business. And if you want them to really perform like an owner, you need to do that. And that's how you actually grow. And I mean, grow big, a B2B service-based business.
Fantastic. I love that, Asteropreneur. We're going to make sure to kind of link all that information in the show notes as well, including your social media links and your company's social media links. So for any individuals that are interested in being a part of the Asterio newsletter, we'll definitely try to link that in the show notes below so everyone will have access to that. Lastly, as we conclude today's episode, we want to really extend our sincere gratitude and our heartfelt thanks to our guest, Jim Miller, for sharing his valuable strategies to navigating the exciting and sometimes complex world of startup finance. If you enjoyed this episode, be sure to subscribe to our podcast for more thought-provoking conversations with industry leaders like Jim. Thank you for tuning in, and until next time.